welcome ladies and gentlemen for afternoon session on the topic Audit Documentation and Key Audit Considerations, Best Practices Design of Checklist, Audit Planning, Memorandum, etc. To present on this topic, we have CA Sharad Rao. I now request CA Shankar Gowda to kindly come forward and escort our speaker onto the dais. I also request you, sir, to kindly welcome our speaker while presenting your floor bouquet. Big round of applause, ladies and gentlemen. Thank you, sir. To briefly introduce, Mr. Sharad Rao was qualified Chartered Accountancy course in the year 1998 and ICAA in the year 1997. He has been working in SR Party Board since the year 2000 in the assurance practices area and currently is working in Bangalore office in Assurance Division as Director Assurances. With this very brief introduction, I welcome you for today's session, sir. Over to you.
And warm welcome to everyone. I think in the morning session, Pradeep had taken you through a lot of a wide range of standards on auditing from 200 to 600. So I do not propose to repeat what has already been covered in the morning session. Rather, the presentation that I am going to make, it's a presentation that I am going to make is more focused on the documentary aspects related to planning and how we can simplify that documentation when we are looking at planning and audit. I think this is one area which even after so many years we always have a deliberation because there is no straight answer as to what is enough documentation, what constitutes the right level of documentation. Right? It is a subjective matter, something that can always be argued one way or the other. So the attempt that I am going to make is to see what do we need to cover from an essay perspective that covers these key aspects when it comes to planning. Only the key aspects. Right? And just to take 2 or 3 slides on putting a context to what is required under the auditing standard. If you look at the standard on audit documentation, right, what does it say? What is the auditor required to do? The auditor is required to maintain adequate documentation such that an experienced auditor who has otherwise not seen your file is able to understand and comprehend what you have done. Right? It is that it's a third party auditor. He or she has not looked at your files. Okay? And when he or she now comes to look at that file, there must be enough evidence on the file to support what work you have done, how you have arrived at your conclusions, and what you have concluded. This is broadly what is required. Okay? If you look at the, there are 2 critical parts to this. Right? The first part is, did you plan and perform your audit appropriately? And did you execute your audit appropriately? We will look at the first part of it, which is plan your audit. Right? And during the course of this next 1.5 hours, we'll look at some of the checklists. I mean, checklists from a standard perspective are not mandatory. There is no standard which says you have to use a checklist. But if you look at the definition of what an audit evidence is, checklists form part of those evidences, and therefore you have the ability to use them as part of your audit documentation and make good of that. Now, what does checklist do? It does not change your strategy from an audit perspective. It does not change the fact that you are going to do the audit the way standards require you to do. But what it allows you to do is make sure that you consider every aspect that is required in the standard, assuming that your standard is comprehensive, and therefore forces you to look at each and every aspect of that particular essay. Right? If you look at essay 300, and Pradeep did talk about it just before lunch. Planning and audit of financial statements deals with the responsibilities to plan and audit of financial statements. The essay requires the auditor to establish an overall audit strategy that sets the scope, the timing, and the direction of the audit. So, three elements we are talking of: the overall audit strategy, the audit plan, and any significant changes between what you have planned and what is happening at the year end. These are the broad requirements. 315 becomes your key standard when you talk of plan, because SA 315 defines, and it's a very big standard. It defines virtually everything that you need to consider as part of your plan, except of course things like fraud, things like so where there are specific other requirements with other standards deal with. Right. If you look at 315, what does it say? The key principles of 315. What you need to document is a discussion among team members. Right. As a team, you are 2, 3, and a partner, a manager, and so on and so forth. What deliberations did you have? Right. What did you discuss with management? What were your observations when you went to your client? How did you so you had a meeting with the CFO of the company, or you had a meeting with the accounting head of the company. What were the deliberations that you had? Right? What did you conclude? It's the first part. Key elements of understanding obtained regarding each aspect of the entity. And we will deliberate about this, because this is such a wide requirement if you think about it. I mean, even a small company, forget a small company, even a kirana shop has so many aspects to its business. For us as auditors, even to understand that business means that we have to be better than that owner of that particular place. Right? Now, that is not the intent of what the standard is. The intent of the standard is to make us aware that we as auditors are required to figure out enough about the entity so that we are able to A, plan our audit, identify the risk of material misstatement, plan our audit strategy, and execute. Now, how we will do that? We will look at it from some of the checklists that we are talking about, but conceptually that's what is required. The identified and assessed risk of material misstatement at the financial statement level and at the assertion level, and this is irrespective whether it's a private company, public company. The standard clearly requires us to say, look, you need to figure out what is the risk at an overall company level. And Pradeep did talk about materiality at various levels in the morning session. So as an auditor, we need to know, yes, is the financial statement of that company materially misstated or not? Is one of those accounts or even one of the assertions of those accounts materially misstated or not? So our opinion not only requires us to opine on the true and fair view of the company as a whole, but also requires us to look at whether any of those accounts or assertions are materially misstated. And this particularly becomes important when we look at differences between us and management. When we have either a qualified opinion, an emphasis of matter, or even an adverse opinion, a disclaimer does not require an opinion in the first place. But when we do have such a requirement or such an issue, if you look at the 705 or 706 standard, it clearly says that as an auditor, we have to then opine. Why is it that we have made a material modification to the audit report and consequential impacts and so on? And what is getting impacted? So, is it revenue? Is it net profit? Is it earnings per share? Is it debtors? Is it any other account? So on and so forth. And that starts when we plan an audit. If we don't plan the audit appropriately, then we are not going to be able to say, okay, what is it that is going to get changed at that point of time. Yeah. The risk identified and related control. I think we did talk about the IFC in the morning, and I don't think we need to revisit that. But part of our audit will also require us to evaluate risk and related controls. Of course, from a private company's perspective, the MCA has these exemptions for companies which are below 50 crores threshold. So IFC is technically not required for those companies, even though voluntarily the company may want to ask the auditor to give an IFC. If IFC does opine, then yes, there is a challenge. Now, I would like to ask this question, that if IFC does not apply, do you think that we are not required to identify controls and test internal controls, even if it's a private company, if it's a small company, if it's a mid-sized company? Any views on that?
We need to test.
We need to test, right? If you think about it, IFC is a concept which came in the last few years, right? It was the standard of auditing, 315, 300. They have been there for years. They have been there for decades. Even before IFC came, the requirement was always that we identify controls, we understand controls, we test controls. Nothing has changed in that. What has changed is the fact that MCA has allowed smaller companies not to report on those controls, right? And therefore, to that extent, if you think about it, when IFC came, the challenge was earlier under the company's auditor's report order. We were required to talk of internal controls on specific areas, right? We were talking about sale of goods and services, purchases of inventory, and so on and so forth. But when IFC came, Caro removed that requirement because it's thought that IFC is replacing that. On top of that, what happened was MCA gave a notification exempting private companies, but did not amend Caro to bring back that same requirement in the company's auditor's report. So today, there is a double exemption to a private company in that sense. If you look at SA 240, 240 is what? Fraud. And it's an onerous responsibility on auditors. Thankfully, the standard clearly says auditor is not primarily responsible for preventing or detecting fraud. Having said that, there is a very material public difference of opinion as to what constitutes an auditor's report and what the standard says as an auditor's report. Right? In fact, if you look at the new auditing standard on SA 700, which is not applicable this year, fortunately, it is March 2019 onwards, the new standard actually clearly now says that the auditor is not responsible for identifying fraud. It may so happen that our audit procedures do not identify material misstatements because of fraud, right? And that is something which is good, because then you are making the reader aware, look, I am as an auditor not primarily responsible, it is management which is primarily responsible for fraud. Having said that, if you look at 240, there is enough requirement on us to do specific procedures to conclude that we have identified the risk of fraud, evaluated that risk of fraud, and done enough procedures to conclude that there is no fraud in the financial statements. Right? Now, how do we achieve this harmony of where the standard gives us a very top-down 20,000 feet view to say, look, you have to understand the entity, you have to understand the management, you have to understand their controls, you have to identify what is the fraud risk, what is their internal controls, and the way you look at it, it is quite overwhelming to think we are required to almost understand everything about that business. Right? And it is true. It is a part of our responsibility also virtually to be in that position that we understand the business as much as the businessman himself does. Otherwise, we will never be comfortable signing off on our opinion. There is another standard which also says consideration of laws and regulation, and I find this standard very onerous. Why? It's because as an auditor, we are required by law to understand each and every law which has a material impact on the financial statement. Now you think about it, if it's a manufacturing company, maybe a big one, small one, whatever it is, can you guess how many acts are applicable to a single manufacturing company, even if it has a turnover of 10 crores in the state of Karnataka? Just a guess. Sorry?
8 to 10.
8 to 10. Okay. Any other guesses? Actually, I can tell you, and I am not telling you a number, but I have seen a report which details out there are at least 35 different laws which are applicable to any company in the state of Karnataka. 35. Now, if you think of that and you think of the standard on auditing, the way it is worded, it means that as an auditor, then I have to be an expert on at least 35 laws. It seems to be a very onerous task on us. But thankfully, I think the way the lawmakers or even the standard has been written is that we therefore need to be able to conclude what is critical to that company and what is maybe a day-to-day transactional affair, and therefore what is going to cause a risk of material misstatement on that company and what is probably a routine law which otherwise is not going to happen. Now, for example, we have this Independence Day coming up, right, next week. Under the Shops and Establishments Act, no establishment can be opened. The fact remains that that's a law. As an auditor, we should be aware that under the Shops and Establishment Act, the company cannot open its offices. Right? Simple thing. But the fact remains that how many such laws do we know? How many such laws are we aware of? And what implications do they have? Now, suppose you have a company which opens its office on the 15th of August. Set aside the fact that they are being disrespectful to the nation. But from a legal perspective, what is the implication of that? As an auditor, then what is it that we are going to do about it? Yeah, it's difficult, right? It's not that we will have that competence to be able to say, look, either the director goes to jail, there's a fine, there's a penalty, provide for it, and so on and so forth. So the point I try to drive is that as an auditor, therefore, we must be able to articulate, and that's going to be the key word, as to why we believe an income tax act, a companies act, a goods and services act, service tax is no longer there, foreign exchange management act, and so on and so forth. These are some of the big laws which really impact the company. Right? They can have material impacts on the company even if they are non-routine in nature. Company not able to realize its foreign currency receivables over a long period of time. RBI is not going to be very lenient. Companies Act, directors have not filed, and you've seen those examples where the ROC is becoming really tough on companies which are not filing their accounts or directors who have failed to disclose. In fact, the recent controversy around directors now wanting to go to court because ROC is forcing directors to disclose their Aadhaar. Now, and this is a very typical. So, what is our responsibility if a director does not disclose his Aadhaar to the company? And this is a current issue, and I was reading it in the newspaper that MCA is forcing directors to please provide us details of our Aadhaar. Many directors don't have Aadhaar, and they are planning to go to court. Some of them, that's a news article. Now, as an auditor, what is our responsibility in this? Any guesses?
In the long form audit report, somewhere bringing up this topic there.
That's one part, and where I think we'll park this question because there is a specific requirement under the ICAI that we need to evaluate this, and we'll look at it in one object, or maybe we can just talk about it and look at it. If you look at it, ICAI requires us to do a KYC on all the directors. Yes, that is part of our engagement acceptance. SQC1 requires us to do engagement acceptance. We need to look at the TIN numbers of all the directors. We need to ensure that they have filed their 164.2 requires us to report whether they have been complied with the law. Right? Now, tomorrow, if a director does not have an Aadhaar, are we going to put that in 164 saying sorry, director is not qualified? Now, that's going to be a legal interpretation. Said gentleman, he is a director validly appointed by the company under the provision of Companies Act. Right? The fact remains, technically he is non-compliant on one of the provisions which the MCA by way of circular etc. is trying to enforce. What does that imply for us in the auditor's report? When we as auditors are required to specifically comment, are the directors disqualified as on 31st of March 2018? Are they qualified or disqualified? it becomes difficult to take a judgment on this. And this is actually something which happened last year, and we saw that in many cases when MCA started this entire exercise of cleaning up companies which had not been filing their accounts, that otherwise people who were directors in multiple companies, because they were directors in multiple companies and one of those companies had not filed their accounts, then they started getting notices saying you cannot be a director in any company. Right? Now, that is their problem. The problem that we as auditors are going to have, what are we going to write in 164.2? Is he qualified? Is he disqualified? Right? And some of these things are things which we need to document our understanding and articulate why we believe we are right in our report. And that's where these kind of checklists kind of start helping us. The last thing I'm going to talk about in terms of conceptually what this is, and is our requirement to those charged with governance. Now, those charged with governance, the standard is very simple. It requires us to talk to audit committees, it requires us to talk to management on a regular basis. Thankfully, this standard does not require us to make an audit committee presentation. There is no such legal requirement. We can talk to those charged with governance on phone, we can talk to them orally, in writing, so on and so forth. Right? So I am not going to discuss on presenting a checklist around this. Just to be aware that we are required to communicate with those charged with governance. And let's dig down a bit deeper. And if you look at these standards we talked of, we talked of 315, we talked of 300, we talked of some others. These are very long standards, and the way we can kind of break it down is to look at the key steps that needs to be performed to achieve that same thing, which is completion of an audit plan. Right? There is no rocket science to this. It is simply breaking down the entire 300, 315, 200 and so on, 240 into specific requirements to say, look, if I do these 15 steps, then I am done with audit, right? Or the audit planning part of it. And we'll look at some of these in detail and how kind of we can simplify the entire audit planning process. And if you think about it, the steps are fairly logical in sequence. Evaluating compliance with independence. We accept an audit. We are required by the Companies Act, by ICI Code of Ethics to figure out we are independent of the company. We will talk about some of the independence requirements later. Right? We need to have an engagement acceptance or an engagement letter. There is a specific standard around it. We just talked about it, we have to understand the entity, we have to understand the environment in which the entity is existing, understand the internal controls related to that entity. To perform analytical procedures, this is a specific requirement under 315 for this. We have to perform analytical procedures, and we come to why this should be done. We have to identify the risk of material misstatement, either due to fraud or due to a significant risk. And we'll spend a little bit more time on this. Obtain and evaluate related party transactions. Needless to say, related party transactions are somewhat of a challenge. If you look at the way the regulator is now kind of harping on related party transactions, it will take time to settle down. It will take it will get diluted over a period of time. In the last 3, 4, 5 years, first they said related party transactions, Companies Act brought in a prohibition. You cannot have related party transactions unless there is a voting on material related party transactions. SEBI then went on to say, look, your definition of material related party transactions is not correct. There are different materialities from a SEBI perspective. Now, if you look at it, recently the Quota Committee report, what it has done is that for listed companies at least, they have said, look, if you have a related party transaction, that related party transaction, even if it wants to, cannot vote on that resolution only to approve a related party transaction, even if it is part of a group. So even if it is not a party to a transaction and it is a part of a group which otherwise, suppose holding company and subsidiary company both have transactions in that company, the subsidiary related party transactions are getting approved, even the holding company company cannot vote on that, which means it's only non-related party which can vote on it. Now, it is slowly getting more and more tighter from a governance perspective on related party transactions. At the same time, there is a lot more focus on disclosures. If you look at Caro, for example, the Caro 2015 brought in the requirement and put responsibility on us to specifically say whether all related party transactions have been disclosed in the notes to accounts as per the applicable accounting standard. And that, I can tell you, is a very big challenge for us. How do you know, and Pradeep I think talked about it now, how do you know there are two barter transactions which we are not aware of? I don't know. I mean, I could have just given a laptop to a subsidiary company. He has given me a laptop to a subsidiary company. Technically, there are two related party transactions. Right? Now, they would have squared off saying, okay, your laptop and my laptop, both are the same, let's square it off. But how, from a legal perspective, is that correct? It still needs to be disclosed. Right? Thankfully, for a private company, at least they have had the sense to say, look, this is not that critical. For a public company, yes, it's going to be a challenge. Identify and test entity level controls. We will not talk too much about it because there is a checklist and we will talk through when we look at this checklist. Determine materiality. Assess inherent risk. Inherent risk is what? It is the risk of susceptibility of an account to a material mistake. And we will see some of the examples as to how to identify inherent risk. Determine the combined risk for each significant account. Prepare an audit plan in summary. And last but not the least, fold a planning event. Just a logical sequence of steps that we need to do. If we do this, I am fairly confident you would have covered at least 80% of your planning for the account. We will discuss more about this in detail. I think the asterisks that you look at on these slides are those events where you can choose to use a checklist to bring in efficiency, and we will focus on this particular aspect. So my proposal to you is that we will spend time on these steps: establishing the team, which is including the use of a specialist, evaluating compliance with independence, identify the risk of material misstatement due to fraud and significant risk, assessing your inherent risk, determining your combined risk for each significant account, preparing an audit strategy memorandum, and holding a planning event. I mean, these are select topics that I would like to spend time on with you. And I don't think that we have time beyond this to kind of deliberate today, but certainly if time permits, we can take up more. So let's start with the first one, SA 300. Identify your team. Who's your team? Definitely you, your colleagues, your partners, your execs, interns, managers, so on and so forth. But it also includes other members. Who are these other members? In any company, irrespective of size, unless it is a very simple company where your total net profit is equal to 33% tax, any company which is a tax-paying company, or even if it's not a tax-paying company, the fact that it's not a tax-paying company itself requires you to evaluate tax. Now, you can choose to do that yourself if you believe you have sufficient knowledge, or you can choose to involve one of your colleagues who is an expert on that. So you can choose to have a tax specialist. Right? There can be litigations for different reasons in a company that will involve the use of tax experts, unless you are yourself representing the company. Right? In any company today, well, I know for a fact that in North India we still use the traditional system of buy khata, and if somebody has had the opportunity to look at it, the single entry system which has been used by traders for generations. And at least you would have seen in movies, right? The long red book which opens like this, and there will be a Munimji sitting and writing. So that system still prevails in North India in trading companies. They still continue to, they prepare a set of accounts in Tally. They continue to maintain single entry system, and they still continue to keep cash as the resulting balance. Right? But I don't think that we will ever be able to audit that by khata. Right? We will at least be auditing through Tally, be it Tally, Scala, some package that the company is using. Maybe a bigger one, slightly more complex, maybe the biggest one, SAP, Oracle, so on and so forth. Technology today is such that we cannot ignore technology when we are considering audit. Even Excel has a problem. In fact, I will share an example with you, and this is maybe 15 years back. I know of this company, and we were not the auditor, but I know of this fraud which happened in the company. The inventory was a resulting figure. It was derived from outside the books, and it was determined in Excel. And the gentleman who was maintaining inventory was a master in Excel, and he used to write really long formulas. It took the auditors 3 years to figure out that his formula went down all the way and came back to the same cell. And when they did realize that the inventory was materially overstated. Now, I am not saying that the auditors were at fault or whatever that case may be, but fact remains that today technology is such that unless we have a hands-on knowledge of technology or we have somebody else helping us with technology, we are likely to miss out on some of these critical aspects. I am not saying it is fraud in every case, but there will certainly be complications. Now, just the fact that if it's a tally, the older versions of tally allow the company or the account to delete entries. In an ERP, there is no concept of deleting an entry, right? You can reverse the entry, you still have an audit trail. You can go back all the way to whatever 10 adjustments have been given time, cost, etc. considerations. But the fact remains you can do it. In an older version of Tally 8.0 or something, I recollect very well, you could just press Ctrl Delete and the entry would get deleted. How do you figure that out? Right? You have no control on that. As an auditor, what are you going to do with it? Something to think about. Company does an acquisition or it disposes a subsidiary or a branch or even a division. And there will always be challenges in that, right? There will be tax challenges in that, there will be business challenges in that, there will be people who will be either acquired, there will be people who will be transferred, there will be tax implications of that, there will be IT implications of that because their system, our system, we are giving them part of our books, n number of complications, right? Any acquisition and disposal requires you to think through what kind of an expert you need. Actually, something which always creates a challenge for us. Right? Actuarial valuation is a highly specialized skill. It is not a skill that we as auditors have learned as part of our CA course. We are not actuaries, we are chartered accountants. Right? So to rely on actuary, we need to be able, when an actuary is an expert, right? So therefore we need to be able to figure out what is the actuary doing, how is he doing, and how is it that he is concluding. Therefore place reliance on that, right? And there may be others. So I think at this point of time I would like to just look at a simple template on the use of specialist. In engagement. Just give me this. These are just one page checklists, so it's not very long, it's not complicated, not very difficult to understand. As part of this SA 300, there are 2 or 3 things that we need to be clear about. What is key that we need to evaluate? A, do we have the right team? It means, do I know enough about this industry, and especially if it's a typical industry. So many manufacturing companies are simple, but real estate, it is a very difficult industry to operate. Infrastructure, you must have that expertise, that knowledge to know what risks are there in those. Jewelry companies, these are high risk companies, right? And therefore, do we have the right skill set to be able to perform this audit? One is a commercial consideration, but the other is the fact that there is an expectation that we do our work in a way that the reader of financial statement gets reasonable assurance that there is true and fair view, right? And therefore, we must be able to say, look, I know this business, I know what are the risks. Do we have any experts? We talked about this. What are experts are we going to use? Okay. If you look at the essay, what does it require us to do on an expert? Now, many of us would have looked at SA 600. SA 600 is a very common thing because in console financial statements, we can be a console auditor, somebody can be a subsidiary auditor. What do? We carve out, we say, look, I have done this portion of work, somebody else has done this portion of work. Right? It's the same with experts. You are placing reliance on that expert, right? Except that you are not carving out. You are owning up to the expert's view, and actually gives you a gratuity liability or a leave encashment liability. You are owning up to that data. You are saying, yes, this is fine. Now, how are you fine with that? What work did you do to say, look, I am fine? You would have looked at the inputs. You would have looked at whether he has used a discount rate, whether he is independent of that entity. He is not somewhere doing another engagement with the entity, and therefore the view that he is giving you is a skewed view. Right? Key considerations. So, three things in this form. What is our competence? What is the competence of experts? Are they independent and objective? And we can simply document these considerations as part of this. The last box I have kept open, which is SQC1. Can anybody tell me? And this is agnostic to any kind of an engagement, irrespective. It can be even a certification. There is a specific requirement under SQC1 for us to document what challenges can come when we are evaluating the engagement team. Anybody who can recollect that SQC1? No? Well, it's fine. It's a very it's buried somewhere, and it does not pop out immediately. The standard says that the risk that you carry is being too familiar with the company or with the organization. So one of the challenges that you must be aware of, that if you are auditing an entity for too many years, you tend to know, or you tend to be too familiar with an organization. Right? So therefore there is a requirement that you have a policy in place after whatever, and I think the requirement is 7 years. An engagement partner needs to rotate out for 7 years. Or if you do not believe that that particular issue is a challenge, then you need to have at least a second person look at your work as an independent partner to say that you have done enough work, and therefore just those 2 lines of SQC1 here will help you mitigate that. Okay? Any questions on this? Yeah. You can move on. Independence. Sounds funny, right? That we have to evaluate independence. We are obviously independent of the company. But it is not so simple that we are independent of the company. What is independence? Independence, if you look at it, independence is in the mind. Independence cannot be proven. It cannot be put on black and white that I am independent of you. I could have known you for 15 years. Right? There could be a different relationship altogether. But the fact remains that the standard requires us to evaluate that independence. And what it requires, there are only 3 things which it requires us to do. Evaluate business relationships, evaluate financial relationships, and evaluate personal independence. And we'll talk about each one of these in a minute. What is business relationship? Business relationship is I have an engagement with XYZ company. I have an engagement letter to provide an audit service. That is a business relationship. Right? Now, why is it important that we evaluate a business relationship? Anybody?
Because you might have a conflict of interest.
Absolutely. If you look at Companies Act, and that is agnostic to whether it's a private company, public company, so on and so forth. Irrespective of the fact that whether we are providing audit services to a private company or to a public company, there are specifically 9 kind of services which are prohibited to us. So if we are proposed to be the auditor of a company, be it a private, public, big, small, those 9 services can neither be provided to that company, to the holding company of that company, nor to the subsidiary company of that company. Right? Now, this was always there. It is not new. It's just that it is coming to the Companies Act. ICAI always said, look, you cannot do these services. Code of ethics was always there. Right? But you need to evaluate now. You need to put down on paper, look, either you have an engagement, existing engagement, either with that company, the holding company or the subsidiary company, or you have nothing. 2 lines. Right? Financial relationship. What is financial relationship? You are auditing a branch of a bank or a bank itself. You have loans from the bank. Right? Now it can be in your individual capacity, it can be in the capacity of the firm itself taking a loan. There is a financial relationship. You are auditing a mutual fund, you have invested in that mutual fund. Can you do that? No. Right? So things like that. So it is just to be aware of the fact that in those specific circumstances we need to document that we do not have any such relationship. Personal independence. Easy one. Okay.
Your relative is working for the company.
Your relative is working for the company. Easiest one, you are not owning any shares in that company, right? Hopefully not, right? So specific considerations that we need to do. We can look at a simple checklist on this. We have to document these things which I talked about. All we have to do is evaluate yes or no. Is there a business relationship? Is there a financial relationship? Do we have an issue on personal independence? Document that and we are done with this particular concept. Right? Understand the entity. This is a big one. We talked about the fact that what all we need to understand. And this is going to be a generic one. And I would like more to hear from you. What are your practical experiences when you say understand the entity? What comes up to your mind? What all do you discuss with the company? What all are you aware of when you say I have understood the entity?
The nature of the business, the nature of the sales pattern, the channel partners, how do they operate?
Sure.
Their place, how do they operate?
Right?
How do they do the invoicing, collect payments, the entire what they call business flow.
The business flow, right? You talked about the fact that who are their customers, who are their suppliers. Okay, what else? What else do we need to understand? And just think logically. When you are doing your audits, you know virtually everything about that company. Now, what is that virtual everything include?
Total market size and market share.
Market size and market share. Very good. What else? Sorry, can you speak up, please?
Industry, the industry in which it operates.
Industry in which it operates. Absolutely.
Licenses.
License. Well, license Raj is no more, but yeah, license, you would have looked at licenses. But there are still, you are right, there are still licenses free. Sure.
So, any changes in the operating areas of the company, like if it's a telecom,
Absolutely.
like previously they might have had Andhra Pradesh,
Right.
now pan-India, and any investor has significantly invested in their company.
Right. Absolutely.
Whether you are proposing to do an M&A or any restructuring
Very
exercise,
Absolutely.
you plan to do.
Yeah.
And in terms of new products, like which will involve attraction of GST or service tax, freebies, like free talk time vouchers, telecom companies are issuing.
Absolutely.
Which might not have happened yesterday, the
Yeah,
last financial
yeah.
year. And any change in your board of directors,
Very critical.
change in your key management personnel,
Right.
and any attempt to get some significant loan or something from banks or institutions.
Their financial strength today.
Financial strength, and any risk of the court judgment coming adversely against you, which will have a significant impact on your financials.
Absolutely. Very critical. 100% agree. Anybody can add to that? I think fairly we've discussed most of this, and it just shows the gamut of what we need to know to be able to say we understand the business. Right? We need to know everything. We need to know the law, we need to know the company, we need to know their competitor, we need to know the industry, so on and so forth. There's no end to it. Now, when you think of...
One question.
Sure.
You were mentioning previous slide, that there are some 9 assignments which, as a stat auditor, you cannot do
Right.
the company or the holding company. Can
Right.
you just list down those?
Yeah, so let me just go back to the checklist.
Because I just went through one of our credits note or something like that. Like, you
Sure.
know, a stat auditor can do valuation, he can do, other than tax audit, I think he can do any engagement is what I understood.
No sir, so if you look at the background here, I'm not sure if it is visible to you, but I hope so. No, this is not.
You can read out that.
Okay, so if you look at section 144 of the Companies Act, the specific engagements with the statutory auditor is prohibited from doing are as follows. Right? It says bookkeeping and accounting services, internal audit services, design and implementation of any financial information system, actuarial services, investment advisory services, investment banking services, rendering of outsourced financial services, management services, and any other services that may be notified in the future.
So it means if you are a stat auditor,
Yeah,
you can't be an NIS consultant.
you cannot, sorry.
Can't be an EAS consultant with them. You statement of the financial.
So I think you have to understand that the word that is used here is that design and implementation of financial systems. So what are you doing? Are you advising them what is EAS, or are you telling them, look, you have to change your entire process? No, this control needs to come in.
What
If-
about they give you raw financials?
Hmm.
You are preparing the statements, financial statements under EAS.
Right. So you are providing bookkeeping services to them.
This is not bookkeeping. The company has already maintained that.
Right. So from trial balance, you are helping them to get to an Ind AS financial statement. That's what you are saying. So you can guide them definitely. Okay. As an auditor, your job is to certainly guide the company as to what are the standards, what are the disclosure requirements, and so on and so forth. Right. Now, whether the company, if you look at it, the accounts ultimately belong to the company. They don't belong to us. To us, what belongs is literally 5 pages. The main audit report, the Caro report, the internal controls report, and that typically goes on into 5 different pages. And that's what really we are owning up to. Rest everything first has to be owned up by management. Not that we are not owning up to it, but first it has to be owned up. So it is their primary responsibility. We can help/guide them, but we cannot be in a position to say we take onus of your financial statements. Sorry, onus of financial statements belong to the management. Okay. So if you look at our audit report, just let me complete that. In our audit report, what do we say? Management's responsibility of these financial statements. Right? Management's responsibility is what? These financial statements have been prepared by the company's management in accordance with Section 143 of the Companies Act, blah blah blah, and so on and so forth. 133 of the Companies Act, read with companies rules, etc., etc. These financial statements have been prepared by the company, not be prepared by us. They are taking responsibility. Sorry. Please.
Yes. We don't take onus or ownership of the EAS timeline.
Right.
But we assess them getting the final financials, the Schedule 3 of the Companies Act, prepared under EAS,
Right.
provided the company is notified for EAS.
Right.
And then of course ownership is in the company only.
Absolutely.
Is there a conflict of interest?
No.
Somebody raise a bill?
No. Absolutely not. In my view, if you think about it, what are you doing? You are guiding the company to say, look, this is India's 115. 115 requires you to do revenue, what has moved from your last revenue standard, which was applicable till March 31, 2018. 1st of April, this is your new standard. Have you complied with it? Management will do an evaluation and say, yes, we have complied with it. These are the 5 disclosures that is required. So you are therefore guiding them to say, look, please prepare financials according to the Ind AS requirements. You are not preparing their financial statement. If you are preparing their financial statement, yes, then there is a challenge.
I used to work for mandatory services.
Sure.
Where SL by EY, so maintained by the signing.
Sure.
What will happen is telephones, wireless telephones that are installed in the subscriber premises.
Sure.
They have the proper property of the company.
Right.
Therefore, you need to do a year-end stock reconciliation.
Right.
So when property purchases, these are that it will be matched with the subscriber risk, assuming that is there in the subscribers.
Yeah.
At the subscriber's risk, it should match with.
Hmm.
So that reconciliation, to the extent the company is incapable of doing, some assignments we used to give.
I think we may want to look at the structure of that or understand in more detail, but in a very high level, because that, and maybe we can discuss that more in detail outside, is the fact that if you're thinking about a reconciliation between your books of accounts and physical, right? Typically, what will you do? You will do an agreed upon procedures. You will say, look, I have agreed this to the books, I have agreed this to the physical, right? And that is what the auditor in that case can independently do, an agreed upon procedures.
It is not part of the start audit.
As not as part of the start audit. An agreed upon procedure is still something that the start auditor can do. That's it. So my apologies for that. Let's go back to this. Right. I think we covered this understanding the business in a fairly comprehensive way. Right. I don't want to spend too much time on this, but then I want to run through some of the key aspects that I think are important. Understanding who is the shareholder of the company, first and foremost. Who owns the company? Do we know? Are we assuming that they are the promoters, or are they holding beneficiary interest? Right. Is it a part of a group? If it's a part of a group, who are the subsidiaries? Who are the associates? Who are the joint ventures? Who are the joint operations? And this is something which India is forcing us to do. In the erstwhile Indian GAAP, at least you had the concept of joint control of assets. Now you no longer have that. Right? What are the branches? Right? We need to be able to articulate that. We talked about list of directors. What are the goals, objectives and strategies of the company? I mean, we'll talk about more of this when we come to the fraud risk discussion, but think about it. This is what is going to help us identify the risk of fraud. We talked about list of acquisitions, disposals, very rightly. Understanding all the key laws. Obtaining the organizational structure. Okay. How does it operate? Who does what? Right? Obtaining list of key competitors, products, obtaining list of key customers. There is a specific requirement for us to review the accounting policies at the beginning of the year. It is not just end of the year. Please understand, 315 very clearly says, as an auditor, the first thing we need to do is read the accounting policies, see if there is a non-compliance either with accounting standards or, as the gentleman just rightly pointed out, if there is a view which is taken by management which is contrary to industry practice on a particular accounting treatment, the auditor must get an understanding of that on day one. Not on the last day when you are signing off your audit report, but on day one. Document how your management generates MIS and so on and so forth. I mean, these are some of the examples that I thought were important. And to that extent, in many of these, there are specific reasons why we need to evaluate. There are, for example, if you are saying obtain list of directors, there is an ICI KYC requirement. If you are talking of related party, we have to be aware of fraud and so on and so forth. Right? And we'll move on from there. Entities internal controls, and we talked about it very briefly. The fact that today we still need to understand the entity's internal control is mandatory because IFC is no longer applicable to smaller companies, but does not mean that we don't understand. What we need to understand in the internal controls of the organization, not necessarily that we identify and test transactional controls when we are doing either a substantive approach or when IFC is not applicable, but we must be able to do at least some amount of transactional testing even then, and we'll come to that. Why even in a company where there is no IFC applicability, you will still need to identify controls and still need to test some controls. It cannot be everything, but still some you will need to do. And we'll come to why. We'll have to evaluate the significance of risk and the likelihood that significant risk is going to occur, and we'll talk more about significant risk. in the next slide. So what is fraud? Any takers? Simple definition. Fraud is an intentional act by one or more individuals amongst management or those charged with governance, employees or third parties involving the use of deception to obtain unjust illegal advantage. Today, what is our responsibility on fraud? And I know we talked about the fact that we are not the primary responsible, but there is a specific reporting requirement for us, right? Caro still requires us to talk of fraud either discovered by us, in which case then we have additional challenges, or when discovered by management and it is deemed to be material, right? So even in that situation, we will have to report under Caro. So therefore, not identifying the risk of fraud is not something which is a luxury. We will have to evaluate the risk of fraud. What is significant risk? Any takers?
Significant risk is how big it will be in terms of the financial statement, right? Like a travel and
One component of it.
can happen. Somebody can claim 1,000 rupees tomorrow.
So it's a risk which otherwise is a simple risk, but because of its magnitude and the likelihood of occurrence, it becomes so important that unless we address that risk, the audit that we do is going to fail. And I'll take a very simple example here. Okay. You imagine a company whose entire operating profits are dependent on a particular line of inventory, right? And that inventory is dependent on a particular law. I'm giving a slightly complex scenario here. The law changes tomorrow. Okay. We have these GST rates, right? Now the GST rate, thankfully they are coming down, but if they had gone up, right, many of these companies, unless they were passing on that GST benefit, would have absorbed those benefits, right, or absorbed those increasing rates, unless they were able to either take credit of that or they were able to hike their price. Assume they are not able to do either one of them, right? What will happen? It will be a straight hit to the bottom line. Right? Now, something like this can really wipe out a company depending on what size it is, what's their operating model and so on. Okay. So we must be aware what is it that we are talking about. How complex is that transaction? I think we talked about acquisitions and disposals. Typically business combinations or acquisitions or disposals are complex. There are tax complexities, there are accounting complexities. Any acquisition or disposal, unless it's a merger between a holding company and a subsidiary company, I would presume is always a complex transaction, right? And always a significant risk. Significant transactions outside the normal course of business, right? Company otherwise into nice trading, manufacturing company starts doing money lending. Something outside the ordinary course of business, okay, presents a significant risk to the company. What do we need to do for fraud risk and significant risk? Any idea? I have put down the key things that we need to do. Make inquiries. SA 240 actually is very simple in its deliberation as to what auditors need to do. Auditors need to deliberate amongst themselves with the management what is the risk of fraud. Document that. Okay. In theory, that is all the standard says. Okay. It says in addition to that, once you have identified, you do procedures. But to identify that, do your planning, discuss amongst your team and document. That's all it is. What do you do? Anybody here who has heard of the fraud triangle? So if you look at the bottom half of this slide, there are the top three bullet points, which is what are the incentives or pressure points, what is the attitude or what are the opportunities which is available, and what is the attitude of the rationalization. This is typically called the fraud triangle, and let's just understand why. When does fraud occur? Either there has to be an incentive of somebody, right? Somebody is taking kickbacks, okay, or somebody is under tremendous pressure. Management is forcing you to show great results, right? Intense pressure. Incentive or pressure. Opportunity, always Unless there is opportunity, neither incentive is going to work nor pressure is going to work. What are the opportunities which can be? And what is the attitude of management, or what justification do they give to such acts? If a manager, if the management or the CFO of a company says, but I am doing this for the benefit of the company, right? I am not doing this for my benefit. It's all for the good of the company. What does that tell you? That that person is either going to take risks or is already taking risks which will allow him to cut corners, because in his mind that act or that the justification for doing that is it is for the good of the company. Right? So the attitude of the person is very critical to identify risk of fraud. Now, as an auditor, we are not going to interview all 100 employees of an organization. No, that's not our job. But yes, we typically interact either with the owners, with at least the finance manager or the chief accountant, somebody below him who is helping him pass entries in tally, and so on and so forth. Right? So with people who we are interacting with, we must be clear what are the incentives and pressure on them, what is their mindset, what is the attitude that they carry with them. If we are able to highlight these, we would have identified where is the risk of fraud. Okay. The last two bullets are more from a materiality perspective. Is it likely that it will happen? Now, frauds can be multiple. It can be simply somebody forging a medical bill, and you've seen many of those examples in the press. Right? 100 rupees becomes 500 rupees, existing medical bills suddenly turn up. Those are also frauds. Right? Or there can be bigger frauds. There can be siphoning of money. There can be illegal taxes being avoided, etc., etc. Right? Depending on what. So, is our responsibility going to be to find out each and everything in that? Are we going to start looking at each and every voucher in that company? I mean, in a very small company, probably yes. Maybe there are totally 500 vouchers. Possible. But that's not going to happen even if there are 10,000 vouchers in the company, right? We will end up doing sampling, we will end up looking at the top risk areas, we will end up looking at account balances to say what is material, what is not material. So therefore, fraud will always be top down. It can never be bottom up. If we do bottom up, the likelihood of missing the bigger picture will always be there, and that is why this fraud triangle becomes very important. Okay, now I will not take too much time on this. What is required of us when we identify a fraud risk? Not fraud. What is required of us when we identify a fraud risk? And mind you, 315 very clearly says that unless you are able to justify why, revenue recognition by default is a fraud risk. So any company, at least unless it's a cost plus company, because in a cost plus company revenue is only a resulting figure, but any other company, fraud by default is your risk that you are going to carry. Now, so revenue is your risk that you are going to carry, unless there are other risks that you are going to look at. But what do we need to document in that? We need to document these 5 things. What is our overall response to those assessed risks? And this is both for significant risk and fraud risk, mind you, this is not just fraud risk. The nature, timing of the procedures that we are going to perform, the linkages of those procedures with the risk of material misstatement. What are we specifically doing to address the risk of fraud? What is it that we have done to conclude that there is no fraud in the company based on our assessment of what fraud could be? Okay. The results of those procedures, what communications we have made to management regarding fraud. I think you have to read the sentence very, very carefully. The requirement of the auditor is to document what is the communication made to those charged with governance or with management with respect to fraud, not with respect to suspected fraud, not with respect to risk of fraud, not with respect to what procedures you are going to do of fraud. If there is a fraud which is known or identified, you have to document what communication you are going to do with management. Okay. The risk of fraud is part of your work paper, it is not part of management's work paper. The risk of what substantive or control-based procedures you are going to do is your work paper, not management's work paper. It is only when you have identified a fraud what documentation needs to happen is what did you communicate to them, right? Now we digress here for 1 minute, and I had asked one question: what is our responsibility if we find a fraud as opposed to management finding that fraud? We have to inform the central government immediately. Is that in all cases?
Only above 1 crore.
1 crore. That is threshold.
So does anybody remember the threshold?
1 crore or 1 crore I think.
If I remember correctly, it's 1 crore. Now, the requirement to report to central government actually has a step behind it. We are required to report to central government after we have communicated with those charged with governance. We have to first give it in writing to them. This is what we have found. Kindly investigate. Management is required to do that work and provide us with their conclusion on this. If they don't do so within a specified timeline, then we are required to report to central government. It is not that we find a fraud, we immediately write to central government. That's not. Okay, I would like to look at one more checklist here, especially around fraud and how we document both the identification of a risk of fraud and what responses we should document around that. Sorry. See, that's a governance issue. Okay, it is a governance issue. If from what I have seen or read in the press, what is it that is being deliberate in ICICI? The fact that there were loans given to a related party which was otherwise not disclosed, and we talked about related party transactions. Now, at no point of time, at least till date, have I seen a press which says that these loans are bad, that these loans are written off by ICICI. The issue that is currently deliberated, and it could change going forward, so I have no view on that, is the fact that the person who was otherwise supposed to disclose this as a related party transaction did not disclose, and therefore the company approved, the bank approved something without thinking that it is a related party transaction, and that became the governance matter. Now it may so happen that the loan can be good of recovery, it can be bad of recovery. If that loan tomorrow becomes bad of recovery, it will add to that entire episode to say, look, this should have been deliberated at that point of time.
Sir,
Sure.
again, the loans were given, this is what I have read in the press, loans were given by ICICI over a period of last 15 years.
Yeah.
Because Videocon has been a customer of ICICI for the last more than 15 years.
Absolutely.
And in 2005 or 6, when SBI became the lead consortium banker, they wanted all other lenders to consolidate their exposure to ICICI and arrive at and become part of the consortium.
Sure.
And at that time it was quantified at some 3,500 crores or etc.
Yep.
from ICICI to Videocon.
Sure.
And it has also been serviced properly by Videocon until recently, before it turned out to be an NPA.
Right.
Now, Videocon has never been a related party of ICICI.
Right.
Videocon invested in New Power, which was run by Ms. Kochar's husband. So, whether Videocon uses this loan money to invest in some relative of ICICI Bank's KPI, key management personnel KMPs, that how will the bank know? That is point number one. Second point, suppose this circle has been found out, should not the bank auditor raise this as a possible, it goes beyond a related party transaction.
Yep.
There could be a border case, thin wall of difference between a fraud and a related party transaction. Should he not have alerted the management?
Right. I think, and I am no expert in this, but I would just like to respond to one specific point, that the fraud or it is not yet concluded as a fraud. Please understand. Right? ICICI has so far not concluded this matter as a fraud. All it has done is that it has asked somebody to investigate that matter. Without a complete investigation, you and me are going to only speculate. But given the fact pattern of what you have just described, the fact that there was a potential conflict of interest between the managing director and a company in which the bank was about to lend money should have been considered as a related party transaction and should have gone through a different approval route than what currently has gone through, and that is the key issue. So today, even if SEBI is asking the same question, it is asking exactly the same question. Why did you allow it to go through in this route? This is a related party transaction. Why was this not disclosed as a related party transaction? What is your process in identifying that related party transaction? Right? That is the notice which has been issued. Now, how it will pan out, and some of this also becomes political. So, I mean, there is nothing that we are going to gain by deliberating on this, but the point remains that it highlights the fact that how related party transactions today have become such a bone of contention, right? And even such a well-known person is asked to move on, resign, and so on. Right?
So, what is the responsibility of the stat auditor in this particular case?
There are two things, and I don't know how much time we have, so very briefly. The stat auditor is required by law to obtain from management a list of all related party transactions. Right? CARO requires statutory auditor to comment whether transactions with related parties A have been disclosed in the way accounting standards require to disclose, B whether those transactions were at arm's length. So there is a very onerous responsibility on the statutory auditor. It is not just the fact that you have disclosed everything, you can disclose everything, but also you have to figure out whether that transaction is at arm's length or not. Right? Now, the stat auditor is in that sense handicapped by many things. The fact that the company did not itself know, or the bank itself did not know it's a related party transaction. Is it that we as auditors are required to go beyond that and find out from all sources all over the world what are related party transactions? Probably not. It is not the intent of the law as well. But we are required to do enough diligence to look at what are the disclosures by management. So in this particular case, the key managerial personnel, what interest do they have, dependents, independents, close relatives, and so on and so forth. And then evaluate whether there are any transactions either with them in their individual capacity or in their capacity as respective employees of those organizations. So to that extent, there is an onerous responsibility. We cannot simply say that it's management's problem. No, there is some amount of responsibility. Okay. Quickly to move on, if you look at this, I have just put down revenue recognition as a fraud, but to highlight that particular fact that revenue recognition in not all cases becomes a fraud, right? So we split up this example to say, look, there is an infra company which has both product sales and project sales. Because product sales is a routine transaction, it's a simple company, one single product being sold, we don't think that there is a fraud risk in that. At the same time, it's also an infra company. That company has an ongoing project. Now, as an auditor, our biggest challenge is what? How is management estimating what is the cost which will be incurred in that project? Right? As an auditor, we are never going to be those technical experts. Right? It is either the project manager, it is either the management, or in very rare circumstances, a specific expert who can give you that answer. Right? But never auditor. Never. Okay. What do we document here? What is the risk? What is the account or the assertion which is getting impacted? Then, what procedures are we planning to do? And the procedures that we are going, we will not spend too much time on the procedures we are going to do. We'll just look at the left side of this. What are the overall responses? What are the specific responses that we are going to have against this? What is the risk? of management override. There is only one paragraph in 315 which talks of risk of management override. If you look at it, what it says is that especially in smaller companies, you look at the fact that the owner manager has complete control over everything. There is always a risk that the owner manager has the ability to override his juniors, override the processes, override the banking system for the setup for his company, etc., etc. You cannot rely only on substantive procedures. In those cases, you have to do some amount of test of controls to conclude that there is no fraud. Why it becomes important? Because if the owner manager has the ability to override a substantive, a particular process, and this particularly applies to estimates, you have a provision for doubtful debts. Typically, you will end up discussing either with the CFO, and if you don't agree with the CFO, with the owner. Owner will always say, look, what I am telling you is based on this is correct. Now, it could be correct, but there is a significant management bias in that estimate. So what is it that we as auditors can do? Are we competent to say, look, what the organization is correct? No. We can independently assess what that estimate needs to be, but over and above that, we need to look at in that entire chain, who all have approved that particular estimate. Were they doing their job when they were doing that? And if yes, then what he's saying makes sense. If you don't do that, the chances are that what estimate is being given to you is completely biased. Okay. So what are we going to do to assess this? And finally, what is the risk that we are addressing, which is fraud risk, and specifically what procedures we are going to do on this. Now, I don't propose to show you for significant risk separately, but this typically will be both for fraud risk and significant risk, the way you can document your work here. Moving on, inherent risk. We talked about inherent risk, and we already talked of significant risk, we talked of fraud risk, etc., etc. How much time do we have? 5 minutes? Sure. So let me not deliberate too much on this. When we already talked of inherent risk, so I'll just show you the template. You can look at it at your leisure. I mean, unfortunately, we did not have enough copies, so I will mail those soft copies to the institute, and they will be, you can download them. So you can look at this. Say, if you look at inherent risk, okay, what are we required to do at a significant account assertion level? I'm not sure why it is on, but we are required to consider inherent risk both at an entity level and at an account level. Therefore, you can use this checklist simply to identify what are the risks, map it against each significant account, put a high low against each one of them, deliberate whether the sum of highs and lows gives you an overall high or an overall low, and therefore conclude what should be your inherent risk for that particular account at an assertion level. It's a simple Excel template. Highs and lows are getting plotted, and at the end of it, it's a count if formula, so it picks up the number of highs and number of. Critical to make sure that we talk about which assertion we are talking of. So completeness, existence, valuation, rights and opinion. So each one of these can be then deliberated, and that forms then the basis of whether your combined risk becomes your inherent risk for the purposes of determining your combined risk becomes high or low. I think combined risk we will not talk about, because you either plan to rely on controls or you don't plan to. And if you plan to rely on controls, you will do test of control. We'll simply jump to the last section, which is on test of control. I mean, once you've done your identification of inherent risk, your control risk, you're now at a stage where you're going to assess your combined risk, right? what is your account, what is your inherent risk, what is your control risk, are there any fraud risk factors that we need to be aware of, what are the substantive procedures we are going to do, and therefore, and nature, timing, extent of the procedures that we are going to do. So it's a simple word template. It is fungible. You can customize it to the requirements. Okay, having come to that, come to the last slide. If you look at this slide, this is to say we have done all of this. We have understood the entity. We have identified significant risk. We have identified fraud risk. We have understood what are the internal controls. We have designed the procedures for our substantive work. Now it is time to sit down and deliberate. Are we missing anything? Therefore, in my experience, it is always very critical that just that half an hour or 1 hour sitting together puts into perspective that are we covered in terms of what we are required to do from a planning perspective. Therefore, this list is not a kind of a hard copy of what needs to happen, but it's an indicator. If you have done all of this, chances are that you have planned your work appropriately, and therefore you can go out and execute the way you want to execute. So if you look at it, you understood what are the scope of your services, your engagement letter, what you understood your environment, significant changes, you know what is your engagement calendar, you have identified risk of material misstatement, you have identified your materiality, you have observed from analytical procedures what has changed from last year to current year, and therefore identified potentially any risk of fraud there. You have deliberated amongst yourself what are the significant accounting and auditing issues. Okay. And if you are planning to rely on internal audit, what procedures will you do to place reliance? And just a sequential list of what you can do. Your audit planning memorandum follows from here. The summary of what you have discussed goes into a simple document, which is the audit planning memorandum, and therefore then you have reached the end of your planning stage. Right? I think with that, I would like to conclude. If there are any questions, I am happy to take them now.
I have a question in terms of fraud risks, because
Sure.
this comes repeatedly also into the internal controls and financial reporting. Has the management assessed fraud risks? Have you assessed fraud risks, and so on? So, no, not. So, typical fraud risks like you say revenue recognition and let's say cut-off procedures and something unique to the industry. That is something 3, 4, 5 things probably you will be aware, management will be aware.
Yeah.
But is there any systematic way in which this can be done so that you can go again on the test of completeness? Okay, what are all the, let's say, top 10 or 15 key fraud risks, maybe from a fraud database, something, so that you can say, okay, establish that these are the fraud risks that are there. These are the ones relevant to the industry, so we have covered that in our assessments.
I think I deliberately skipped one slide more in the interest of time. If you look at this, when you do your planning, there's this whole list of things that we do in planning. When you do your planning, and wherever there's a red mark, you will see that we have written there. So the step when you do here allows you to identify the risk of fraud. Planning, when it is done in a systematic way, you will end up identifying the risk of fraud, right? Because all you are doing is putting together your knowledge, your experience, the background of that company, what you have learned with other audits that you have done so far, what is your knowledge of the changes in law, etc., and it will bring that perspective in picture. See, fraud is something you cannot generalize. Every fraud is unique. Every fraud. Why? Because the moment that fraud is discovered, it gets plugged. So the next fraud which happens either it may be still inventory, and it may still be that the person is dealing with scrap inventory in a different way. But you will find that the same scrap inventory being sold is being sold in a different way from the previous fraud. Why? Because the person who is doing it is different. His thought process is different. There is no way that as an auditor we can get into the minds of, like I said, 100 plus employees. So it is our ability, our experience, our knowledge, our interaction with the client, our interaction with our colleagues that brings that perspective as to where is it that there can be a fraud. It cannot be that we have a template and we say these 10 things, fraud is done. No, then we are missing out. by default. Right. If there are no other questions, I would like to really thank you for giving me this opportunity. I look forward to interacting with you again soon. This is mine.
On behalf of all the members present here and also on behalf of Bangalore branch, extend my sincere thanks to CA Sharad Rao for an excellent presentation. Big round of applause, ladies and gentlemen. As a token of gratitude, I request CA Geeta Madam to kindly come forward. Bangalore branch past chairperson to come forward and present a moment to our speaker, CA Sharad Rao. Thank you, madam. Ladies and gentlemen, let's break for tea for half.